So easy, so easy. So easy, so easy.
What's up, EasyEquities community? Are you ready to learn a little bit more about ETFs and the Nasdaq 100? I know I am, but I'm an ETF geek that way. I can never get enough. Anyway, it's really awesome to have you all here. Thanks for joining our webinar. I'm going to introduce you to my co-hosts. Firstly, I want to introduce you to a new face, or maybe not so new for some of you. His name is Kalo, and he's going to be joining us today in this webinar to chat with us. Kalo is actually an EasyEquities investor just like you, who's so passionate about investing that we scooped him up, and he's just started working with us at EasyEquities. So I'm really excited. He's 1 week in, so go easy on him. But I'm really excited to have him join us on the webinar. And then, of course, there's Kingsley, who you may or may not know from some of our previous webinars. Kingsley is our Satrix expert. He's the Chief Investment Officer at Satrix. He's got loads of experience in terms of research, portfolio management. Basically, this guy's a genius. I mean, I don't need to say anything else. So I think Kingsley and Kalo, if you could just hop on and just say hi to everyone, and then we can get started.
Hi, everyone. Name is Kalo.
Thanks for that introduction, Carly, as well. Kingsley here.
Nice to have you guys. Okay, cool. So let's get into this. I'm a huge fan of ETFs and I'm very biased. So let's just keep that in mind. But I want to just talk a bit about them because I think there's still so many investors who are kind of not sure what ETFs are, or maybe they're a bit intimidated by the concept. So let's break it down a little bit. What are ETFs? ETF stands for Exchange Traded Fund. And basically what they are, in very simple terms, is a selection of companies that you can invest in with one transaction. And these ETFs normally follow different themes. So you might get an ETF that tracks the top 40, for example, which would be the top 40 companies by market capitalization. Or you might get an ETF that's like, okay, cool, we're focusing on dividend paying companies or companies in the financial markets. So it's quite a nice way to invest in, a specific industry if you're not quite sure of the individual companies within that industry that you might want to focus on. An ETF is just a really nice way to do that. I want Kalo to kind of also jump in here. Kalo, what's your vibe on ETFs? Are you a fan? Are you team ETFs? What's your vibe?
Well, I sort of like have mixed emotions when it comes to ETFs. I mean, at the end of the day, I'm a person who actually loves risks, but at the same time, you wouldn't want to see your money just going away just like that. So usually when it comes to ETFs, they are more of like, the safety bag, ensuring that one way or the other might be risks involved, but it's much more minimal as compared to ordinary stocks. So I'd say I'm in between. I think just like you, I'm still deciding on whether I'm a fan of ETFs or not, but more of about that. For me personally, I'd still say ETFs are for someone who actually does want to actually minimize their risk. ETFs are actually a way to go.
Hey man, there's no reason why you can't have the best of both. I'm all about that.
That's the whole point. I mean, I that's exactly what I'm doing as well. Like, I'm juggling both, but at the end of the day, I'm more of a stock person. But once again, like I said, ETFs are one of the best ways to go, more especially if you actually want to minimize your risks.
I like that you brought up risk, and I think it's important to kind of go into that a little bit. I mean, the reason why ETFs do minimize your risk, and that's not to say they're completely risk-free. I mean, all investments carry some level of risk with them because there's no crystal ball that's going to tell us exactly what happens in the market, right? But because you've got a bunch of different things instead of just one thing, you're kind of spreading that risk out. It's that old, don't put all your eggs in one basket. This is like having a few eggs in a few different baskets. So yeah, it's definitely mitigates that risk factor. We're talking about our personal preference here. So I'm going to speak about my vibe. Okay. So I love ETFs for my tax-free savings account. My tax-free savings account is like my #1 account. If you guys don't know this already, you can invest in a tax-free savings account up to 36,000 Rand a year. And any gains you make, any dividends you get, any interest you earn in that account, all the good stuff, you don't get taxed on, which I think is like, I mean, why not take advantage of that? And ETFs are the things that you can invest in your tax-free savings account. So for me, I use my tax-free savings account as like my nest egg, my retirement baby. I want my risk to be a little bit lower in that account. Obviously, I want to take some risk, but you know, ETFs, it's for me a bit of a safer way to do that. So I do my ETFs in my TFSA, and then in my ZAR account, there's where I go and pick those individual stocks that I'm really, you know, feeling good about. I'm happy to take a little bit of a risk on. So that's how I roll. But you know, each to his own. Taylor, I want to ask you a bit more about you and your personal journey. So, like, when did you start investing? Why did you start investing? Let's start there.
You know, when you actually ask when did I start investing, I don't know if whether you're talking about really investing or mentally, because from a young age, I've always had this idea that, you know, I really need to take my money, go to a specific company. There's this one company that I always have in my head every single time when I start talking about investing, ShopRite. I've always had this idea to say that, you know what if I was to go to ShopRite manager and be like, listen, here's my money, buy stock, and then once you guys make profit, then you guys will decide on how much you guys are giving me. You know, so as I started having that idea, that's when I actually came across EasyEquities. I was like, okay, no, what is this? And that's when I actually realized that, okay, no, at this point in time, I don't necessarily have to like have a specific amount to start investing, because I've started going to various banks where, you know, when you're talking about the term investing, everyone knows investing is all about associated with people with money and so forth. But coming along with EasyEquities, that's when I realized that, oh, okay, no, everyone can actually invest. And that's when I actually started my investment journey somewhere around about last year. And from there on, that's when I actually started learning more about the market, more about the economy and so forth, which is, for one, is actually more eye-opening in my way of saying it, because it doesn't just only speak about investing, but it actually broadens your mind far beyond just investing to entrepreneurship and many other things. So for one, I actually started my investment journey around about last year.
Wow, that's cool. It's amazing how your perception starts to change when you become an investor. And like you said, you don't need $1 million in the bank.
Well, I mean, that's how it was with banks. I mean, they always tell you that like you need a minimum amount to start investing. I'm like, okay. And one or the other, I can't remember one of the banks where they mentioned like, I think I needed somewhere around about 30 to 40,000 Rand only to start. I was like, wait,
Wow.
what? Okay, no, where am I going to get that money? But more about that, I was passionate about it. And luckily for me, that's when I actually came across EasyEquities, which has actually given me the opportunity and privilege to actually become an investor and a shareholder. So, I mean, every single new investor is always happy about this email that always comes up saying shareholder. You know how great it is to receive an email saying shareholder. You're like, okay, you know, start feeling a bit more important. But yeah,
like
more
boss,
about that.
Right? And
yes,
Peter, like now when you walk into a shop, right, do you get this feeling like, yeah, I'm a customer, but I'm also a shareholder, you know?
Well,
like,
yes.
Something about that.
There's always that thing, you know, when you're walking around knowing that at any point in time, you might receive an email saying, dear shareholder. You know, I feel like I could even call my friends and be like, guys, we are going places. At that time, we only have one share, you know.
Nice. I like that. Okay, so for everybody listening today, just a couple of notes. Some of you joined a bit late. Don't stress about that. We're going to be recording this webinar. We're going to be putting it on YouTube. So if you want to go back, check out some of our banter in the beginning, you're more than welcome to do that. If you have questions, drop them in the Q&A. We're going to be taking some questions at the end of the webinar. If we haven't covered something, we'll take a look at your questions and see if we can get to it. But I can see we've already got some fans of the Nasdaq 100. I'm so glad we're going to be chatting about this specific ETF today because so many EasyEquities investors love this ETF. So I'm going to rope Kingsley in here. Kingsley, can you tell us a bit about this ETF. I mean, I know that it's filled with sort of game-changing companies, really innovative companies, and it is quite tech-heavy. But maybe you want to give us a little bit more information about the companies inside this ETF and why they've all been put together.
Yeah, hi, Carly. Thanks. I think let's just take a step back and think about what the Nasdaq is and what that exchange represents. It's always been, I guess, at the forefront of the finance industry and the stock exchange industry in the US. You may have seen some old video footage or had the privilege of actually being on the New York Stock Exchange floor, or some, certainly seen some footage of that. But it's still very much a open market. Deals are done by shaking hands. Am I coming through, Carly?
Yes, you are. Your
okay, cool.
visual and your sound's a bit disjointed, but we get the gist. We can put it together.
So yeah, I mean, on the New York Stock Exchange, they still do deals by shaking hands and meeting face to face to trade stock in large blocks. But the Nasdaq's always been an electronic exchange, and it was quite revolutionary in bringing electronic trading to the financial markets. And it's always been a supporter of or a platform to enable innovative and smaller companies to be able to access the capital markets to realize their growth aspirations. So that's a little bit of the sort of the Nasdaq story. And the Nasdaq 100 index in particular is actually designed to capture specifically those new world type businesses. You might have also heard of the Dow Jones index. It's an industrial index really meant to capture those blue chip industrial companies, I guess old world economies that represent the US industrial market. The Nasdaq you can think of as being the new world economy companies, and the Nasdaq 100 specifically also designed to capture those industrial companies, for want of a better word. It excludes financials, but industrial companies operating in the new economy, and very much with an innovative flavor in terms of what they do and how they do business and how they sell their products and services to the likes of you and I. And I think that's a very interesting point around the companies on the Nasdaq. Although they're US companies and they're listed in the US, I can actually show you this on a slide or two, in a second. But these companies are global in nature, and if we go through that list, you'll actually see most of those companies are household names we're familiar with. And if they're serving us as customers here in South Africa, well, then they're not just serving the US, they're serving customers around the world in all different markets around the world. So these are truly global businesses, and for that reason, and it's essential that you don't miss out on being exposed to them because they are almost too large to ignore.
Yeah, I think you make a really good point that I didn't touch on in the beginning of our session when I was talking about the benefits of ETFs. The benefits include, and speaking specifically about the NASDAQ 100, the ability to invest in overseas markets, but using your rands. So you're not going to have to go worry about currency. You're able to invest in these companies with your rands and get all the benefits of that currency exposure. So I think that's another benefit just to highlight there. And when you talk about the companies in there, I think when we start looking at them, everyone's going to find their favorites. I found mine already. One of the companies I know is in the NASDAQ is NVIDIA, and I'm a huge fan of that. It's a US company that is in the gaming space. They do sort of processing units and all that kind of thing. And I've been watching them for a while, and they're doing lovely things in my USD account. So yeah, I'm happy to see them there in the NASDAQ as well.
Cool. So let me just share what those constituents look like, and then I'll jump around through some slides just to touch on some other aspects on why the NASDAQ 100 is such a compelling investment, or has such a compelling investment case. So these are the largest 20 companies in the US. I hope my screen's coming through and yes. You can see that. Yeah. So these are the largest 20 companies in the US according to the S&P 500. And so I've plotted what their weights are in the S&P 500 in this column over here. But I've also then shown which of these companies are included in the Nasdaq 100. So you'll see, depending on which exchange these companies are listed on, they're either in the Nasdaq or they're not. So if they're listed on the Nasdaq exchange, then they're eligible for inclusion in the Nasdaq index. And also if they're financials companies, then they wouldn't be included in the Nasdaq 100 index because it specifically excludes those. But like I was mentioning earlier, if you run through this list and particularly look at the companies that are in the Nasdaq over here, I actually am not aware, there's no company in this list that's listed on the Nasdaq that I'm either not aware of or even using their products and services. Apple, Microsoft, Amazon, Facebook, even if you're using WhatsApp, you're using Facebook's products. Alphabet is Google. Tesla, we don't really have Tesla in South Africa yet, but who doesn't know about Tesla and Elon Musk, right? And the amazing things he's doing. NVIDIA, you mentioned, making chips and graphics hardware. So yeah, very innovative company, right up there at the top. PayPal, Elon Musk also has connections with PayPal, so they're right up there. And then Adobe. We all use Adobe and PDFs and Acrobat and a lot of their other enhanced graphics software. So those are the companies which are really global in nature. And you can see some of the ones which aren't included, which would be in the top 20 of the US. Some of the more blue chip companies, there's some big financial names there, Bank of America, MasterCard, Visa. That's because they're listed on the New York Stock Exchange and not on the NASDAQ. Or they might be operating in the financial sector and therefore aren't included in the NASDAQ. So,
can I ask why that is, Kingsley? So this specific ETF excludes companies in the financial sector. Is there sort of reasoning behind that? Is that just a strategic thing?
Yeah, I think it was to create a comparable new world economies index like the old world Dow Jones Industrials Index, which is an often quoted index in the US to represent what the economic activity is that's happening on the ground, so to speak, without, financial companies, which obviously play a significant role on the stock exchange, but often they're not necessarily tied to what's happening on the ground from a main street or an industrial perspective. So you can think of NASDAQ 100 as being a new world economies index to also reflect what's happening on the ground, so to speak, but perhaps less on the ground, more in the ether, because a lot of them are electronic and virtual in nature in terms of their business models and the products they provide.
I mean, Visa and PayPal, you could argue, are sort of touching on that financial theme, but they are IT companies at the core. And like you said, more groundbreaking. Yeah. I mean, PayPal, for example. That's on the NASDAQ. Exactly.
And so some of the companies which aren't financials, you'll see they're listed on the New York Stock Exchange, and that's obviously that company's choice on where they want to have their listing or their primary listing. And so the NASDAQ index specifically only looks at companies listed on their exchange. Yeah. But I'll talk a little bit about the themes that the NASDAQ index captures, but we can get to that once you're done. The other thing I wanted to just also highlight here is I've put the price of these stocks to buy one share. Now, I know EasyEquities has got amazing technology to be able to fractionalize and buy portions of a share. But, coming back to Kayla's point around that minimum investment that banks often require you to have in order to open up an investment account. One of the reasons for that is, if you wanted to buy one share in Amazon or one share in Google, it's going to cost you $3,000 to buy one share or $2,500 to buy one share. Now, that's a lot of money in rands just to get one share. So, this is the other massive benefit of an ETF is that it aggregates, in the case of NASDAQ 100 shares and packages it in a very affordable vehicle locally in rand terms for you to get exposure to all of those companies through one transaction. And I mean, that's just amazing.
That means you only pay brokerage once as well. So
exactly.
Yeah, keeping your fees nice and lean as well. Nice.
100%.
So maybe we should talk a bit more about, I don't know, should we look at how's this thing doing? Like, is it doing well? What has it done over the last few years?
Yeah, so I'm going to jump to that. From a performance perspective, I'm just going to go back here a second. There we go. So this is actually how Nasdaq has performed in dollars. So this is a very important point to highlight, because when you invest in rands, like investing in the Nasdaq, in the Satrix Nasdaq 100 ETF, you're buying that offshore exposure in rand terms. So there's two key variables you need to understand when you do that. The first is how that investment or underlying investment strategy is performing in dollars, which is what I'm showing you here. The second one is what the currency is doing, what the rand dollar exchange rate is doing, and I'll come to that in a moment. So this is what the Nasdaq has done over a long period of time. So just to explain this chart, it's a log chart, which means, you know, every grid line here is doubling in value. You can see it goes from 100 to 200 to 400 to 800. So it's exponential in nature. So what that means very simply is, if the index moves from the 100 line to the 200 line, that's 100% return. And obviously, if it drops down from one line to a line below, that's a 50% loss. So you can see through the history of this index that, as you mentioned, Carly, there is risk associated with investing, particularly within equities. And there have been a couple of significant events that have occurred over this history, over the last 20 odd years, that I've plotted performance of the Nasdaq. So the one significant moment was the dot-com bubble, which you can see bubbling here, and then the dot-com crash, where it lost not 50%, but probably, 75% of its value, with it going down from sort of 200 levels to below 50. So massive erosion of value, as all of those expensive, and a lot of them were very speculative tech companies that dominated the Nasdaq at that time, corrected, because there was a lot of over exuberance, and investors were pricing in earnings that hadn't yet materialized, but on the expectation that there would be massive earnings to occur in the future. We then obviously had the markets recover, and then we were faced again with the global financial crisis, which happened over here. And again, you can see it lost pretty much close to 50% of its value. But since the global financial crisis, there's been what we've heard called quantitative easing, where central banks, and particularly the US, have lowered the cost of borrowing and made monetary supply and the access to capital more easy by lowering the interest rates. And that's given rise to one of the longest bull markets we've experienced in history.
Wow.
I think what's really interesting is we obviously had the COVID crash last year, or the COVID correction in March 2020. That was one of the sharpest corrections we've seen in history in terms of how quickly the market sold off. But have a look at this chart. It almost doesn't even register here. It's, Nasdaq was obviously a very well positioned, with everyone moving into lockdown and having to work from home, and increasingly using technology solutions to be able to work remotely. So the Nasdaq index actually benefited quite a lot from this, new way of working and interacting with each other. Zoom, which we're using now, one of the big beneficiaries of that change in the way that we communicate and connect with each other and go about doing our business, did phenomenally well as a result of the lockdown. So, that's just a short history on how Nasdaq has done over the years. So I'll just pause there before I show you some others.
And I think what's important to note when you're looking at graphs like this, and I see there's a couple of people sort of making comments on the ups and downs, I think you'll never find an investing chart that is a straight line in any direction. The nature of the markets is that they do go up and down. That is how they work. And so that's why, in terms of your outlook on investing, it's so important to have a long-term point of view, because if you had panicked over there where the COVID dip is, it would have been the wrong thing to do. I mean, look at how it recovered after that, and maybe in 2 years' time, there'll be another dip, or in 2 months' time, we don't know. But ultimately, it's about staying the course and riding out those ups and downs for that long-term benefit. Because if you look at 1999, where we started and where we are now, it's quite a substantial growth over the long term, despite those ups and downs.
Yep, exactly. So I think what's useful when looking at these charts is to also contextualize this relative to the other options that you might be considering investing in. So I'm just going to quickly throw up a few other indices here, which you might be familiar with. S&P 500, I showed you that a bit earlier. So that's a more broader index for the US market. And you can see that, relative to the red line, the light blue line was lagging the S&P 500 over this period for quite a period of time. It has subsequently caught up and then surpassed it. And that also really talks to how technology and these so-called growth companies have really done well post the global financial crisis, which Nasdaq 100 specifically captures in its construct. MSCI World is a broad developed market index, so it has a lot of US exposure in it as well. You can see that index was quite a way ahead of the other two pre-global financial crisis, but the US really being the engine of sort of stock market growth post that, those US focused indices, Nasdaq 100 and S&P 500, have surpassed MSCI World. Emerging markets, and Carly, we're going to talk next week about China, but China forms a big part of emerging markets. And this is the story of emerging markets relative to the US and developed markets. So that's the orange line. And what this chart shows, and I guess this is always an interesting thing when looking at cumulative charts like this, is one has to be very mindful of your starting point. It's also why I put it as a log chart, because it sort of keeps things proportional through time. But you can notice with this chart that there was significant growth in emerging markets pre-global financial crisis, but a lot more muted post the global financial crisis. You can see the slope of this line is a lot more horizontal than the developed market indices, which are more at a 45-degree, 30-degree angle. So that just shows that there's been higher growth coming from the developed markets and their stock markets since the global financial crisis. And I think a large part of that is due to the monetary supply and the stimulus that's been created by the central banks in developed markets to encourage growth. So a lot of that's been reflected in the stock market valuations. But where it gets really interesting is when we look at our own market. Now, I've put our own market, the all-share index, the JSE, into dollar terms. So this is all in the same currency.
So you're doing apples with apples, basically.
Exactly. And you can see that a very similar picture emerges on our local market versus emerging markets. So rapid growth pre-global financial crisis, and then pretty pedestrian, lackluster growth post that for the last 10 or so years. You can see the strong bounce we had here with the COVID correction and recovery. But look how much more amplified that was in our local market. Obviously the Rand weakened during that time, so that's going to be reflected in this performance as well, because we've converted everything to dollars. But our market has bounced very strongly since then. And to your point that you mentioned earlier, this is exactly why you want to remain invested, because trying to time these peaks and troughs is almost impossible. In fact, the very nature of investing in the markets when there's mass panic and there's so much uncertainty, which we don't have to think far back what that was like a year ago. It's incredibly difficult to do, to say, yeah, I'm going to invest more when everyone's selling. So the point is, stay invested, be there for the long term. Equities over the long term have shown to be one of the safest ways to deliver a return in excess of inflation and to deliver real growth.
Nice.
And then one final thing is just to throw the exchange rate on this chart. So think of this as putting $100, converting rands into $100 back in '99, and then this is what those what those dollars would be worth in rand. So it's really just plotting what our exchange rate's doing through time. And an interesting pattern emerges here. You can see whenever global equity markets go through crises or go through a sell-off, you can see the rand tends to weaken. I've indicated that with this arrow here. So that's the dollar strengthening, indicative of investors running to safe haven assets like the dollar. When that happens, the rand tends to weaken. So you can see that happened over here during, during the sell-off of the dot-com crash. Again, during the global financial crisis. Here we had Nenegate, if you remember that.
Yes.
And then the COVID crash. The rand sold off very strongly last year in 2020. But you'll also notice that when markets start recovering and that crisis dissipates, that the rand then also tends to recover during those times. You can see it happened here, happened over here, post-global financial crisis, again after Nenegate, and now again, we've all experienced the subsequent rallying of the South African currency. So this is very important because when you're considering investing offshore, you've got these two variables that I mentioned earlier that you need to consider on investing offshore, or when you're investing offshore, because these two play together to ultimately deliver your performance in rand terms. So I just want to show you that on the next slide. So this one here on the left is what I was showing you on the previous slide, all of the dollar performance, including our exchange rate. This is now converting all of that performance. So whether it's offshore for all of these indices and including our own local market, plotting it all in rands now. So obviously I haven't shown the exchange rate because everything is now converted into rands. And you can see that when you do that, because of the additional depreciation of the rand over the long term, that creates a multiplying effect on your performance for these offshore strategies like Nasdaq 100 when you convert them into rands. So you can see where these charts are ending up versus what their performance was in dollars. And that's because you get that multiplying effect of our depreciating currency.
So yeah, you're essentially, if I could put it in very simple terms, you're giving that investment's getting an extra boost purely for the fact that it's in a stronger currency. Essentially, that's what it is, right?
Absolutely, yeah. And the other thing that I almost prefer not to look at these cumulative charts. I think they're easier for everyone to understand because you can actually see what's happening and the moves through time. But I almost prefer looking at rolling returns because as much as you want to get that long-term perspective of how things are doing, it's also good to see how things are evolving through time. And so this chart, when you look at it and seeing how well our local market has done over this period of time, might create the impression that actually, let me just invest locally because it's delivered fantastic results over this long period of time, which it has indeed done. But as I was trying to highlight, it sort of hides a little bit of the picture because a lot of that performance came pre-global financial crisis. So what I want to show is just one last performance chart, which is a rolling 3-year annualized return. So don't worry about the technical title, but what it's really showing you is what the return has been over 3 years at each point, at each monthly point, what the return has been for the last 3 years. So it's not a cumulative chart like the ones I was showing earlier. And you can see here that, with the green line in our local market in rand terms, how well that did in terms of the high returns that our market was delivering pre-global financial crisis. But how lackluster those returns have been subsequently, and particularly over the last few years, very much in the single digits and below what we would expect from an equity market to deliver. And particularly when you compare that to the high returns, in the case of Nasdaq 100, in the 30 to 40% per annum range versus our single digit returns, which we've been experiencing on a 3-year average basis. I mean, generally with equities, you wouldn't want to be investing for a period less than 5 years. It's very much a long-term investment strategy to unlock that excess return versus what you'll get from cash or more conservative investments. Because it's risky, you need to be invested for the long term. But
Yeah.
this chart shows just what that trend of returns has been through time, and very much showing you that it's been a tale of two halves, with very lackluster returns coming from our local market, and phenomenal returns coming from offshore, where a lot of the action has been over the last decade.
So for me, this also speaks to something that I'm quite passionate about when it comes to investing, and especially for all the new investors that are joining us today. Get your head around the idea of diversification. So I mentioned earlier that that's one of the reasons I love ETFs, is because they offer you this immediate diversification, which means you're kind of mitigating a lot of the risk that you would normally face with your portfolio. You mentioning now, you can look at the South African versus the US and how that's performed. I always think it's a good idea to consider having a bit of both, having a local ETF and a global ETF in your portfolio. And that way you're getting the benefits associated with both. And you're also kind of spreading your risk. When one does better, the other one is most likely going to be doing something else, or could be doing something else. Kayla, what does that split look like for you in your portfolio? Are you more offshore? Do you like keeping it local? What's your mix like?
Well, I mean, like I said, starting recently, I also started with the Nasdaq 100. So now my question is, I mean, still looking at it since I actually started recently with the ETFs. My question would be, looking at it at a perspective of dividends, for a person who actually chases dividends, because we know sometimes we have investors who love dividends.
Are you one of them?
Well, not really. Every now and then. But looking at it, looking at the ETF, how is the dividends payout? Do they pay out regularly? Is the dividends payout good? Because I mean, it has a lot of companies in it, so that's why I'm actually asking if whether the dividends is good. How is the dividends being paid out?
Kayla, I'm so glad you asked that question. You've teed up one of my slides perfectly. So I'm just going to share again.
You didn't answer my question, Kayla. Are you team offshore? Are you team local? Or do you like both?
Well, well, offshores is problematic because it requires a lot of work, right? You have to do a lot of research and so forth. Now, with the ETF for one, you disagree. How do you disagree?
Well, I'm looking at all of those different companies that are in this specific ETF. First of all, I at least know what they do. I know.
But that's the best thing about it, if you think of it. I mean, it's an ETF, so one doesn't necessarily have to do as much research. So if you're more of a person who always invests locally and you're thinking of investing internationally and so forth, ETFs that focus on companies abroad are much more better because it allows you to actually be able to do other things as compared to having to do research on each and every company. Because exactly. I was actually thinking of it, I was like, would I really invest in 100 companies of US? Like, where do I even begin when I have to do research and so forth? But as compared to having to invest in one ETF, it's much more better.
Yeah.
I think the rule I use when it comes to investing, it's almost like that golden rule in property where it's about location, location, location. When it comes to investing, it's about diversification 3 times. That's the golden rule. And but yeah, coming back to your question about dividends, the way the Nasdaq 100 ETFs are structured is they actually automatically reinvest the dividends. And I'm showing you a picture here of Einstein. I'm sure you know that. And it's claimed that he said that compound interest is the 8th wonder of the world. And he who understands it earns it, and he who doesn't pays it, or she. Yeah. So now, obviously, associating a finance quote with Einstein probably overstates the investment industry's intellectual contribution, no doubt. But I think his point is well made, which is that compounding, is powerful. And I wanted to just highlight that in the term, in the context of dividends and why it's so important to actually reinvest those dividends. So I'm showing you everything back in dollars again, but these This is again the Nasdaq 100 index, which actually doesn't pay a whole lot of, well, the companies within the Nasdaq index don't actually pay a whole lot of dividends because they are such high growing businesses that those companies actually choose rather to keep their capital and reinvest it themselves into their businesses. It's only if they've got more cash than they know what to do with, which some of the big tech names might now be in that position, where they actually now distribute those excess profits to their shareholders. The point is, though, you still have the option of then deciding what to do with that dividend. Now, the Nasdaq 100 ETF, which we run, actually automatically reinvests those dividends back into those same companies, which gives rise to that compounding effect. So this chart on the left is showing you the index performance of the Nasdaq 100 and our local market in dollars, just on a price index basis. So what that means is no dividends are reinvested. And you can see that, you know, you've had phenomenal growth from the Nasdaq index and less phenomenal growth from our local market if you didn't reinvest any dividends. But if you had reinvested all those dividends, this is what the chart then looks like. So look at our local market. You know, it goes from sort of just growing just less than 5 times over this period to growing more than 9 times. And similarly, you know, because the Nasdaq pays lower dividend yields than our local market, it doesn't grow as much, but still significantly goes from almost 7 times growth to 8 times growth over that period, which is a significant appreciation in extra wealth by reinvesting those dividends. So I always say to investors, don't take that capital when it gets paid out to you in the form of a dividend. Always put it back in, because it gives rise to that compounding effect. And something as well, which is quite important from a compounding perspective, is the issue of fees, and why it's so important to have a low cost investment structure. I mean, the Nasdaq 100 ETF, which we offer, has a total expense ratio of only 48 basis points, or 0.48%. So fees also compound through time. And you see a similar scenario if you plot charts looking at the impact of different fee structures. The higher those fees are, the lower that cumulative return is. And the longer you do that for, the bigger impact it has on reducing your net return. So this is why fees and keeping your cost structure so low is so important, which ETFs obviously are renowned for being very low cost vehicles.
So just to highlight, if you guys are new to ETFs, when we refer to total expense ratio, you might sometimes see that on an information or fund info sheet as TER. And basically, this is what it costs to run this fund, to administer this fund, to look after this fund. That's what the actual people who create the fund, that's what it costs them. So you want to look at that amount, which in this case is 0.48, I think you said, percent. Yes. And you know, if you were to look at a different ETF who has a similar theme, it might be a good deciding factor for you, because you might go, okay, cool, this one has a lower TER and it does the same thing as this one, but it has a much higher TER. So I'm going to get more bang for my buck if I go for the one that's slightly cheaper. So that could be something that you want to consider. So I'm going to take a few questions, guys, because we are nearing the end of our chat. Sadly, wish we could hang out all day, but we cannot. So I'm going to go just pick a few random questions here and see what we can look at. Okay. What type of companies are in the TFSA? Is it possible to have a TFSA account that's outside the country? And lastly, I'm obsessed with investing in precious metals. Is this possible on the TFSA? So I think I'm going to give you a bit of a broad answer for that. Your tax-free savings account, you can only invest in what's called collective investment schemes. That essentially just means you can't buy individual shares in your tax-free savings account. The reason for that is government brought about this tax-free savings account idea because they thought South Africans are not so good at savings. So we're going to give them a break. We're going to give them a tax break, but we want you guys to be responsible. We don't want you to also lose all your money. And so having collective investment schemes, which an ETF is, means that you have a bit of a lower risk in that account. So in terms of companies, you wouldn't be able to invest in an individual company in your tax-free savings account, but you could invest in an ETF like this one that has a theme. And if you're into precious metals, you could look for an ETF that has those types of companies within it. I can't think of any offhand, but you could research the different types of ETFs and the different themes, and you could go for something like that. Another question we have is, how old is the Nasdaq 100? I mean, years existing. Do you know, Kingsley?
I do know, but I don't have the exact year at my fingertips. I think it started back in the 60s, if I'm not mistaken, Carly.
All good things did. I think music.
Exactly.
All good things. Okay. We've got quite a few questions that are asking S&P 500 versus the Nasdaq. Should we have both? Is one better than the other? I mean, better is a perspective, right? It depends what it is that you're looking to do. From my side, I'm like, the S&P 500 has a lot more companies. It's like a lot broader. And the Nasdaq 100 is a bit more specific. You're looking at more innovative, up-and-coming companies, whereas the S&P 500 includes like all of them. So it depends on your strategy. I don't know if you guys have anything to add to that.
Kayla, do you want to chip in? Or
Yeah, no, I think from my side, I mean, I can actually agree to what you're saying. It also depends on what it is that you're looking for. Like, for example, if you look at the volatility of the different markets and so forth, the risk that you're actually willing to take and so forth. It's not about having a general answer to say this is the best market to invest in or this is the best company to invest in. It's all about what it is that you actually want. So I think I would actually agree to what Carly is actually saying.
Yeah. So Nasdaq is, they're both market cap weighted indices. So they weight the companies in them based on the size of those companies on the exchange. But the key thing is, Nasdaq is a little bit more focused. There is overlap between the two. So, it might not make sense to have both S&P 500 and Nasdaq unless you want broad US exposure, but then you want a little bit more of what Nasdaq offers, which is essentially that that tech, more tech innovative exposure to companies that are perhaps in more of a growth cycle rather than more traditional businesses that may be cheaper from a valuation perspective, have more stable businesses. So it's really a case of what exposure you want. But I think it talks a lot to this notion of thematics, or what we also call mega trends, which are really shaping the investment landscape at the moment. And one of those core themes at the center of a lot of these mega trends and thematic investment styles is what we call technological breakthrough or technological innovation. And this is obviously revolutionizing the way we do business, the way we make things, the way we sell things. You can think about different manufacturing technologies, the innovation in car manufacture at the moment. Tesla is obviously an example of that. The way we sell and market things, we're using online platforms like Zoom at the moment. All of that is revolutionizing the way we do business. And Nasdaq 100 is a great capture of that theme or expression of that theme. So if you like that theme resonates with you in terms of the future, Nasdaq 100 is a better way to capture that specific theme, say, than S&P 500, which is a bit more broader than just tech focused.
Cool. So we've got time for one more question, and I'm going to kind of group a bunch of your questions together. So a lot of you are asking, where can I learn more about investing? I'm a beginner. I'm not sure about all of this stuff, and I'd love to know a bit more. Some of you are asking, where can I get research on these companies? How can I learn more about the specifics of this ETF or the specifics of the companies inside it? I want to read up. I want to learn more, which is such a great attitude to have. I think I'm still learning in my investing journey. I learn new things every single day, and it never stops. So I really would love to encourage that sort of inquisitive mind. I've got some great resources to suggest. If you're new to investing, there are a few different pages and resources that you can definitely check out. First of all, go to the EasyEquities YouTube channel. That's where we're going to be posting this webinar as well. You'll find a playlist there called Easy Learn, which is videos all about these terms: diversification, ETFs, where it really is a good breakdown of that. When you log into your EasyEquities account, you're actually able to navigate to a platform called EasyAcademy. And on that EasyAcademy, you'll learn things like Investing 101. You'll also learn about our platform and how different things work on our platform. Then I would direct you guys to go look at our blog. The EasyEquities blog has a new to investing section, which is a step-by-step on kind of creating a portfolio, buying your first share. How do you choose which share to buy? So really, really simple, easy to pick up pieces of information. And then once you've gone through all of that stuff, some really awesome resources to check out would be our research portal. So research.easyequities.co.za. There we do share specific research. So we go look at Tesla. What's that about? What's happening with Tesla at the moment? Or these are the top 3 stocks that are picked by our community. Go and read up about what's happening with them. We also have a site called etfs.easyequities.co.za, and I love this site. If you are an ETF geek like me, it's a haven. You can go and read all about a specific ETF. You can compare different ETFs. You can see how many people on EasyEquities are actually invested in this ETF. So it's just an endless source of information, and all of those different places will really put you in good footing at the start of your investment journey. I think that there's a lot that you can take out from them. Kayla, do you have any other resources that you think could be helpful?
For me, I was actually also going through the resources that you mentioned, and for one, looking at the academy through the EasyEquities app. It is actually helpful. It actually does help a lot. It did actually help me, for one, starting off my investment journey before I actually started going deeper into doing more research and so forth. So I would really encourage a lot of people to actually start going and start doing that bit of learning through the Easy Academy. It's Easy Academy, right? Yes, the Easy Academy, yes.
And if you're logging on from a different platform, so for example, if you're accessing EasyEquities via the Capitec widget or your Bidvest account, it doesn't matter where you're accessing EasyEquities from. If you have to go onto easyequities.co.za, you can log into our platform the same way you would anywhere else, and you'll have access to that, to the Easy Academy. It's there on our site. So guys, I'm gonna wrap things up there. This has been so interesting. Thank you everyone for joining. I know we didn't get to every single question, but hopefully you can go back, take a look at this webinar. I'll make sure that I post those resources that I mentioned in the video description, so you can go and do a little bit more digging if you like. Thanks guys. Thanks Kayla. Thanks Kingsley. It's been awesome having you.
Thank you guys.
Thanks for having us, Carly.
So easy.